Okay, welcome. My name is Kyle, and this is going to be an e-tutorial on how to solve problem P8-9A from the Pearson workbook. So suppose that on June 1st, Divine Design creates a petty cash fund with an interest balance of $400. During June, Lucy Chow, the fund custodian, signs the following petty cash tickets. So we have some ticket numbers here and amounts and what the item was for. And then on June 30th, prior to replenishment, the fund contains these tickets plus 3440. The accounts affected by petty cash fund payments are office supplies, travel, delivery, and entertainment expenses. So we have the specific items here, and then down below, it gives us the actual GL account. Okay, so requirement one is explain the characteristics and internal control features of an interest fund. So let's first think about, or just discuss really, what a petty cash fund is. So we know organizations keep money in the bank. This is for safekeeping. A bank is considered a safe spot for an organization to keep cash. What's not safe is really an envelope, a pillowcase, etc. But when they establish a petty cash fund, what they're doing is they're withdrawing money from the bank and they're putting it physically in petty cash. So petty cash consists of a combination of bills and coins. It's physical. That's different from a bank because you see your bank balance online. The bank is stored, the cash in the bank is stored somewhere else separately off-site. Petty cash is cash that's on-site and it's physical, so it's coins and bills. And the petty cash custodian is the one that's responsible for managing the petty cash fund, and they keep it maybe in an envelope or a locked box. So what happens is someone withdraws money from the bank account, and in this case, what was it? $400. So they withdrew $400 from the bank account and they put it in petty cash. So bank went down by 400, petty cash went up. So what happens here now is expenditures come out of petty cash. Money goes out. People pay for things with cash out of petty cash. In this case, the items they bought were listed above. They purchased these items with the funds out of petty cash. What goes into petty cash is a ticket. This is kind of like a receipt as verification the purchase was for a legitimate reason. So because a ticket goes in and the ticket has the amount of tickets, so the ticket value, plus the physical cash in the petty cash balance equal the petty cash target balance. And this is what's meant by requirement number one. Requirement one was explain the control features of an interest fund. This means the petty cash balance, the petty cash target balance, is always going to be the value of the tickets that went in plus the cash. So those two combinations, or those two added together, are going to total the petty cash target balance. That's what's meant by an interest fund. It's always in balance. The petty cash target balance will always be a combination of these two. And since the tickets go into petty cash, when money goes out, the petty cash will always have a balance between the ticket and the cash of its target balance. So that's requirement number one. So I'm going to erase this to give us space to work with requirement two once I get there. Bear with me. Okay. Requirement two is on June 30th, how much cash should the petty cash fund before it's replenished? Well, I know the target balance of petty cash here is $400. Now, these expenditures here, we have tickets and we have an amount. the total of these expenditures plus the cash should equal $400 because that was the target balance. So I'm going to add these together. And I'm going to just do it in a cell right here. 26.64 plus 60 plus 29.32 plus 153 plus 127. So there's $367.50 in receipts that went into petty cash. So in this case, it was $376.50. The value of these tickets is $376.5. The value of the tickets is $376.5. So the target balance I know is $400. So 400, oops, minus 376.5 is going to equal something, and that's going to be 2350, I think. Yeah, 2350. So before it's replenished, it should have a cash balance in petty cash of 2350. How do I know that? Know that because the target balance of cash was 400 and the value of the receipts, the tickets that went in, was 376.50. And since it's an impressed fund, the value of the cash, which is 2350, plus the value of the tickets should be $400. So that was requirement 2. Petty cash should have a balance of 2350. But we see here that it doesn't. It told us petty cash had a balance of 3450, so a mistake was made somewhere, and mistakes often happen. So we need to account for those mistakes. Requirement 3 was make general journal entries to create the petty cash fund, and B, to replenish it, include explanations. So I'm going to give myself a journal entry template here. Date, account, debit, credit. So let's see, when did they create this petty cash fund? It was on June 1st. So the journal entry to create the petty cash, what they do is somebody's actually going to the bank account and they're withdrawing money from the bank and they're putting it in petty cash. So the bank account balance is going to be lower by 400 because they're withdrawing $400 from the bank, right? They created a petty cash fund of $400 and they're physically putting it in petty cash. So petty cash is going up by 400. So the journal entry here is pretty straightforward as long as I can remember the date, June 1st. Petty cash is going up by 400. Cash in the bank is going down by 400. And that's exactly what we saw in this picture. Bank went down by 400, petty cash goes up by 400. The overall impact to cash is 0 because petty cash is another type of cash account. There's been no expenditures yet out of petty cash as of June 1st. And the explanation here would be something like to establish petty cash fund. So that was part A of requirement 3, create the fund. Now part B is to replenish it. So let's see here, when are they replenishing it? On June 30th. So I'm just going to put that so I don't forget, June 30th. And we know the amounts here, and it told us the actual expense account. So we have office supplies expense, travel expense, delivery expense, and entertainment expenses. So I'm just going to try my best. I didn't really position myself well to answer this question, so sorry about that. I'm just going to give myself some space here. I'm going to move my template up a bit. Okay, that's a little bit better. And I know likely that I'm going to have to do debits to each of these accounts. So I'm just going to put those into a journal entry template first. Office supplies, expense, travel expense, delivery expense, entertainment expense. So office supplies, well, they bought office supplies here and here. And I think that's it. So it's going to be 127.20 plus 26.64 is going to be the debit for a total of 153.84. Travel expense. So we've taken care now of that one and that one. Cab fare, that's travel expense, that's $60. So if I scroll up, I've done that. Delivery for package, so that's going to be the delivery expense, $29.32. And then dinner for sales manager entertaining a customer, so that's going to be the entertainment expense, $133.34. So all of these expenditures here, we're doing these debits. What this is money going out of petty cash. Remember, what went in were tickets. So money went out, what went in were tickets. Journal entries for these transactions don't happen until the petty cash fund gets replenished. So they don't happen until the petty cash fund gets replenished. We're replenishing it now, so we're doing the journal entry now. So we debit all of those expenses. We need to go to the bank now to withdraw money. We need to withdraw money because we need to put that money back into petty cash. Remember, money went out. Now we're putting money back in. So since we're going to be putting money into petty cash, we need to go to the bank to physically withdraw it. So we're going to be crediting the bank account. How much are we going to be crediting it by? Well, we know the target balance is $400. Right? $400 is the target balance. That's originally what we withdrew. But currently, if we look at this question, and I'm going to erase this and highlight, the fund contains $34.40. So there's $34.40 currently in the petty cash fund. So if I were to do that math, and I'm going to let Excel do it for me, we need to withdraw $365.60 from the bank in order to get the target balance, in order to get the petty cash fund back up to $400. Now, you might be thinking at this point, well, we're done because I've gone to the bank. Now, I decreased the bank by, what was it, 365.6, and that physically went into petty cash. They put that money back into petty cash to put the target balance back up to 400. So 365.6. But if we look at this, if I were to just sum together my debits, 376.50. I can see here that if this equals 376.50 and my credit is only 365.60, something's wrong. There was a mistake somewhere. So what we need to do is we're going to recognize another credit to this cash over / short account to balance out our journal entry. Because the petty cash custodian made a mistake, so we need to reflect that mistake through this cash over / short account. Now, you might be wondering a couple of things at this point. We credited cash, that's the bank account, because we actually physically had to go to the bank to withdraw it, to put it into petty cash to get it back up to its target balance. And you might be thinking, well, we put the money into petty cash, shouldn't we be debiting petty cash again? The answer to that is no, and let's just think about this for a second as to why. At the very top, we already debited petty cash right here. So petty cash already has a debit balance of $400. The amount of cash in it just didn't match that 400. If we were to debit petty cash again, and let's say we debited it by $365.60 because that's the amount of cash that's going in it, the amount in petty cash would be the 400. It already has a debit balance of 400 plus $365.60. But it doesn't have a debit balance of those two added together. It only has a debit balance of 400. So we don't debit petty cash again. So that was part 3, requirement B. We're done with that. It said include explanation. So the explanation could be to reimburse petty cash and bring up to target balance of 400. And then it says here, so the very final requirement, make the July 1st entry to increase fund balance to 500. So now they've decided they want to increase the fund balance from $400 to $500. And this is on July 1st. To do that, what they need to do, we know there's already $400 in petty cash. We just withdrew the money to put it back into petty cash to get it to go up to $400. So since there's already 400 in there, what we need to do is go to the bank, decrease it by 100, because to get it to go up to 500 petty cash, we only need to add 100 more dollars. So we're going to debit petty cash by 100 and credit cash by 100. So that the debits together for petty cash equal $500, the new target balance. So I hope that you found this tutorial useful. This was P8-9A from the Pearson workbook. My name is Kyle. Have a great day.